Hello everyone, welcome to Imarticus Learning. My name is Akshay Chopra. I'm a licensed US CMA with over 8+ years of experience in training and accounting. I've trained over 2000 plus candidates in various professional courses, and today we'll be studying about ratio analysis. So without further ado, let's dive into it. So we're studying ratio analysis. The first question is, what is ratio analysis? Why do I do it, right? So let's try to understand what is ratio analysis. Ratio analysis is a quantitative tool used to assess and evaluate companies. It's very easy to say my company made a profit of 1 crore, or it's very easy to say my company made a profit of 2 crores, right? But a profit of 1 crore for a revenue of how much, right? Or a profit of 2 crore for a comparative revenue of how much? If I take the case of two companies, company A which made a 1 crore profit and company B which made a 2 crore profit, which company is better? You can't say. But if I were to tell you company A made a profit of 1 crore with a sale of maybe around 10 crores and company B made a profit of 2 crores with a sale of maybe about 5 crores. Now convert this into a percentage. So company A made a profit of 1 crore on a sale of 10 crores, that's almost 10%. Whereas company B made a profit of 2 crore on a sale of 5 crore, that's almost 20%. So obviously it's now easier to say that company B is better because they are making 20% profit. This is what ratio analysis does. Ratio analysis helps us to compare companies when dollar values or solid numbers cannot be used for comparison. Ratio analysis is useful when we can't use dollar values or number values for comparison. Now, there are 5 types of ratios. 1. Liquidity ratios. 2. Solvency ratio. 3. Market ratios. 4. Efficiency ratio. And 5. Profitability ratios. These 5 ratios help us evaluate the company on different metrics. And today, we'll be going into each of them individually. The first thing that we talk about is liquidity ratios. Now, what are liquidity ratios? What does liquidity mean to you? Liquidity means, do I have money with me right now? Do I have money in my pocket? Do I have cash in my pocket? Could be direct cash in my pocket, could be cash in my bank account. Any funds which I can access immediately is called liquidity, right? So liquidity ratio tells me, does the company have funds that it can access immediately? Are there free funds available for the company to use rather than being tied up in any clauses? Liquidity ratio tells us if the company has enough money to meet its everyday working capital requirements. There are 2 major ratios over here. One is called the current ratio, second is called the quick ratio. The current ratio helps us understand what is the total current assets, what are the total current liabilities, and for every rupee value or for every dollar value of current liability, how much of current assets do I have? Whereas the quick ratio tells me how quickly can I pay off all my current liabilities and can I still survive as a company? So we have 2 ratios that we'll be going into in detail. Let's start off with the current ratio. The current ratio is a quick liquidity measure. The formula for calculating current ratio is current assets divided by current liabilities. Now, what do current assets mean? Current assets mean any assets which are available to me right now and which will be converted into cash in the next 12 months. Any asset which will be easily made into cash or which can become cash in the 12 months period is called a current asset. Example, accounts receivable. Accounts receivable are people who have taken goods or services from us on credit. We are hoping that our customers are going to pay us back in the next 12 months. One easy way to ensure that customers pay us back is giving discounts, right? Next, inventory. Inventory is also a current asset. This is because we hope and plan that in the next 12 months we will be getting done with our inventory. Sorry. Now, what is current assets? Current assets are any assets which are going to be converted into cash in the next 12 months. Some major examples of current assets include cash, because it is cash already, accounts receivable, and inventory, prepaid expenses. What is accounts receivable? Accounts receivable are the people who have taken goods or services from us on credit. These are our customers who have taken a credit from us and we are hoping that they will pay us back in the next 12 months. One easy way to ensure that our customers pay us back promptly is to offer them discounts. The next current asset is inventory. Inventory talks about all the stock that we have, the finished goods lying with us. Again, this is a current asset because I'm hoping that I'm going to quickly convert that into cash. One easy way of doing this, give good offers and promotions like the Flipkart Big Billion Day sale, right? And prepaid expenses are any expenses which I've promptly paid in advance. Whenever I make a payment to my vendor before I incur an expense, that is called a prepaid expense. Now, the next component of the current ratio is current liabilities. What are current liabilities? Current liabilities are any liabilities which I intend to pay in the next 12 months. Example, short-term debt, accounts payable, obligations of any sort which I have due within the next 1 year. My intention over here is to repay them within the next 12 months, and that is why they are called current liabilities. Now, how is this ratio interpreted? The ratio can be interpreted as 1, less than 1 or more than 1. Let's understand this with a numerical example. Now, let's assume that the company, A company, has current assets worth 200,000, current liabilities worth 100,000. So, what will be the current ratio? The current ratio will be current assets divided by current liabilities, which is 2. What is the meaning in the second case? In the second case, the company has $80,000 of current assets and $100,000 of liabilities. What does this mean? For every $1 of liability, the company has only 80 cents, or the company has only 80 paisa for every 1 rupee of liability. Interpretation: if all the creditors of the company came down and said, we want our money today, the company would not be able to meet its obligation. And because the company would not be able to pay off their creditors, they will not be able to have capital for their everyday operations. They will be running short of working capital. This is current ratio. Current ratio helps us understand, does the company have enough money to run their show for the next 6 months or the next 1 year? Now, we now come to the quick ratio. What is the quick ratio? The quick ratio is also called as the acid test ratio. This tells us, does the company have enough money to pay off its liabilities without depending on inventory? Now, the formula for quick ratio is total current assets minus inventory minus prepaid expenses divided by current liabilities. Now, you might ask me, sir, why are you deducting why are you deducting inventory from current liabilities? Why are you deducting prepaid expenses from current liabilities? Simple explanation. Today, if I were to go to any mall and I see Biba, Zara, any brand offering me, pick anything for 99, a biggest sale, I will only be able to buy it if I have money. If I don't have money, no matter how attractive the offer is, I will not be interested in buying that inventory. And that is what happens. A company might give its inventory away at the cheapest price possible, pick anything for 99, and still the customer might not have money to buy it. Therefore, I cannot say that inventory is an asset which I can quickly convert. I hope to convert it into cash in the next 12 months, but that might not always be the case. Then, let's talk about prepaid expenses. Prepaid expenses are the expenses which we paid in advance to our vendors. And in most business circumstances, you will see that vendors have a no refund clause. There are major Now, the next thing we come to prepaid expenses. What are prepaid expenses? Prepaid expenses are any expenses which I've already paid in advance. I cannot call them a current asset because I will not be able to convert them into cash. No vendor of mine would want to give me a refund just because I've paid them in advance. Hence, I deduct them from my total current assets. So now, coming back, the quick ratio is current assets minus inventory minus prepaid expenses divided by current liabilities. Let's understand the interpretation with a numerical problem. Now, let's assume that there's a company which has current assets of $150,000 and inventory in that includes $30,000. Prepaid expenses included are $20,000. So now the net current assets would be $150,000 minus $30,000 minus $20,000, which will be roughly $100,000. And the current liabilities are $100,000. What does this mean? That means that for every 1 rupee of current liabilities, the company has exactly 1 rupee of current assets. Meaning the company can pay off all the current liability and still has enough inventory which it can sell and survive in the next few months. The next thing we talk about is solvency ratios. What are solvency ratios? Solvency ratios are also called leverage ratios, are ratios which help investors make an informed decision about investing in my company. These ratios help investors evaluate whether my company is a good investment for them or not. There are 5 or 4 different ratios which we'll be talking about. the ratios that we'll be covering under solvency ratios are debt to equity ratio, debt to capital ratio, financial leverage ratio, interest coverage ratio, and debt service coverage ratio. The first thing that we talk about is debt to equity ratio. What does debt to equity ratio mean? Debt to equity ratio is a measure which tells me how much of my company is financed by debt funds and how much of my company is financed by equity funds. If I were to tell you a very simple example, if I wanted to start a business today, I would probably go ask money from my parents. That would be equity, right? I would give them a part of the profits and I would make them co-owners of my company. Whereas, if I were to go to a banker and borrow money and pay a fixed rate of interest for the loan that I've taken and use that money to start a business, that would be a debt fund. So debt funds basically refers to borrowed money which come with a fixed interest commitment. Whereas equity talks about own money or money which I've got from owners of the company and I will be sharing profits with them. I do not have a fixed interest commitment, but I do give away part of my profits. Now, how does this ratio help me? This ratio is calculated using the formula total debt divided by total equity. And it is used to understand how much of my company is owned or financed by me and how much of my company is financed by an outsider. Let's look at a question. Let's assume a company has total liabilities of 2,500 crores, out of which the current liabilities are 800 crores. Therefore, the long-term debt would be 1,700 crores. Now, if I were to look at the shareholders' capital, the shareholders' capital is made of 600 crores of share capital and reserves and surplus to the extent of 900 crores. So now the total equity is 1,500 crores. Now, for a company which has 1,500 crores worth of equity and has 2,500 crores of borrowings or 2,500 crores of borrowings and 1,500 crores of equity, what does that mean? It means that for every 1 rupee invested by the owner, 1 rupee and 67 paisa, or for every $1 invested by the owner, $1 and 67 cents have been invested by outsiders. Now, how do I interpret this? A high ratio means that people have confidence on my company. It means that lenders are willing to lend money to my company. A lower ratio means that people do not have confidence and they are not willing to lend money to me. Another way of looking at it would be a higher ratio means that my company is financed from outsiders, whereas a lower ratio means that my company is financed from internal funding. When my company is financed from outsiders, I have to pay them a fixed interest. When my company is financed by my own money, I have to share my profits. The next ratio we come to is debt to total capital ratio. Debt to total capital ratio is calculated using the formula total debt divided by total debt plus total equity. This formula tells me out of my total finance or funding of the company, how much of it is coming from own funds and how much of it is coming from outside funds. Let's look at a question. Let's assume a company has total debt of 1,200 crores, a short-term debt of 400 crores, long-term debt of 800 crores, and equity is 800 crores. What does this mean? This means that the company has total debt of 1,200 crores, equity of 800 crores. Therefore, total capital is 2,000 crores. Out of the 2,000 crore capital, 1,200 crores is financed through debt. What does this mean? This means that almost 60% of my capital is coming from outsiders and only 40% of my capital is coming from my own funds. This has two significant interpretations. A high ratio shows that there's a lot of financial risk because at any time the lenders might call in their favors or the lenders might call in their debts. A low ratio shows that the capital derived is from equity and it is a more cautious approach to financing the company, or I can say majority of the company is owned by and controlled by the shareholders. The next ratio that we're talking about is the financial leverage ratio, also called as the asset to equity ratio. This ratio is a measure that shows the relationship between the assets of the company and the equity of the company. The formula to calculate this is total assets divided by total equity. Let's understand this with an example. Let's assume a company has total assets of 800 crores and total liabilities of 300 crores. The shareholders' equity would be total assets minus outside liabilities, which is 800 crores minus 300 crores, 500 crores. The asset to equity ratio over here would be total assets, which is 800 crores, divided by shareholders' equity, which is 500 crores, or 1.6 times. Now, what does this mean? This means that, what does this mean? A ratio higher than 1 means that majority of the company's assets are financed through equity. That means that majority of the assets are owned by the shareholders. That means this company has a conservative capital structure. A lower ratio means that the company has used a lot of debt funding to finance its assets. And if a company is using debt funding to finance its assets, any time the lenders could call in their money and the company would have a capital crunch. The next ratio we're looking at is the interest coverage ratio. The interest coverage ratio is a financial metric that tells us, does the company have enough profit to cover its interest commitments? The formula for calculating interest coverage ratio is earnings before interest and tax, or EBIT, divided by interest expense. Now, what does EBIT refer to? EBIT refers to the earnings of the company before deducting interest and tax expenses. And this tells us that how much profit does the company have to pay off its interest liability. Let's look at it through a formula, or rather through a question. If I assume a company has a sale of 1 million and the cost of goods sold is 400,000, that means the gross profit is roughly 600,000. Now, the salaries, rent, utilities, interest expense, after all my operating expenses, my earnings before interest and tax, or EBIT, is 250,000. This company has an interest expense of 60,000. So what does this mean? The EBIT divided by interest, which is 250,000, divided by 60,000 is 4.17. That means the company has 4 rupees of profit for every 1 rupee of interest. The company has 4 times the profit as its interest expense. The company is in a very good position to pay off its interest liability. Interpretation. A higher ratio indicates that the company has sufficient profit and will be able to repay its interest on time, meaning the creditors have low risk and have high confidence to give us further loans. However, a lower ratio indicates that the company does not have enough profit to pay off its interest expense. Translation: creditors do not want to give loan to such a company because they're unsure and they feel this is a high risk for them. The next ratio that we're looking at is debt service coverage ratio. The debt service coverage ratio is calculated. The debt service coverage ratio is calculated using the formula net operating income divided by debt service. What does this do? This tells us how much profit does the company earn as a comparison to its debt. What does this tell us? This tells us how much profit has the company made in comparison to its debt obligations. Let's look at an illustration. A company has an operating income of 500,000 and it has a debt repayment principal plus interest of 300,000. What does this mean? If I were to calculate the DSR, or the debt service ratio, it would be 500,000 divided by 300,000, or 1.67. That means the company has sufficient profit not only to make its interest payment, but also to repay off the loan. What does this mean? This means that the company has sufficient profit not only to pay off its interest but also to repay its loan. A higher ratio indicates the company has sufficient profits and the company will be able to repay loan. A lower ratio indicates that the company does not have sufficient profits and the creditors would feel at risk before funding the company. We now come to efficiency ratios. What are efficiency ratios? As the name suggests, efficiency ratios are ratios which are utilized to understand how efficiently does the organization utilize its assets to generate revenue and manage operations. The most common efficiency ratios are inventory turnover ratio, receivables turnover ratio, payables turnover ratio, property plant equipment turnover ratio, working capital turnover ratio, cash conversion cycle, and operating cash cycle. Let's understand them in detail. The first ratio that I talk to you about is, the first ratio that we're talking about is inventory turnover ratio. Inventory turnover ratio is a metric that tells me how many times was the inventory purchased and sold over a period of time. This shows us how effectively does the company utilize its inventory management techniques to reduce holding cost, to reduce storage cost, to reduce inventory management cost and have good amount of profits. Let's look at an example. Let's assume a company has a cost of goods sold of 500,000 and the beginning inventory is 150,000 and the closing inventory is 250,000. Now, the average inventory would be 150 plus 250 divided by 2, which is 400,000. And the inventory turnover ratio would be COGS divided by average inventory, which is nothing but 500,000 divided by 200,000, which is 2.5. What does this mean? This means that the company is able to buy and sell inventory 2.5 times throughout the year. It's able to replace the inventory 2.5 times throughout the year. This means that the inventory is probably slow moving and it is tying up capital. If this ratio were higher, then that would mean that the inventory is being bought and sold pretty fast and capital is not tied up in closing stock, or capital is not tied up in inventory, and capital is not tied up in unnecessary holding costs. Now, let's try to understand the days sales of inventory. The days sales of inventory is a ratio or a metric that tells me how many days does it take for my inventory, which is sitting in my warehouse, to get converted into a sale. The calculation for this is average inventory divided by cost of goods sold, which is nothing but the opposite of the inventory turnover ratio, into number of days. Let's look at a numerical. The beginning inventory is 80,000, the ending inventory is 120,000, COGS is 600,000, and the number of days in the year is 365 days. Now, the average inventory would be 80 plus 120 divided by 2, roughly 100,000, and the days sales in inventory would be 100,000 divided by 600,000 into 365, or 60.83 days. Translation: the inventory sits in my warehouse or sits in my godown for 61 days roughly before it is sold. This is a low, or this is a bad metric. Why? A higher number of days or a higher inventory days shows that the inventory is sitting in my godown for a really long time. A lower inventory days shows that my inventory is getting sold like hotcakes. And as an organization, I would always strive to have a lower inventory turnover days. The next ratio we look at is receivables turnover ratio. What is the receivables turnover ratio? Receivables turnover ratio tells me how effectively am I able to collect my outstanding accounts receivable. The formula: net credit sales divided by average account receivables. Let's look at a question. If a company has total credit sales of $120,000, sales return of $10,000, sales discounts or sales allowances of $5,000, beginning account receivable $15,000, and ending account receivable $25,000. What would be the net credit sales? The net credit sales would be $105,000 and the average account receivable would be $20,000. So now the accounts receivable turnover is nothing but 105,000 divided by 20,000, or 5.25 times. That means what? This means that whatever is my average credit sales is roughly 5 times my debtors. I am able to collect my debtors 5 times in a year. A high ratio indicates that I have good collection policies and I am able to collect my money on time. A low ratio indicates that my credit management policies are bad and it takes time for me to collect my money. The accounts receivable ratio is continued further or can be further assessed using the accounts receivables days ratio. What is the accounts receivable days ratio? The accounts receivable days ratio is a ratio that tells me how many days on an average does it take to collect my receivables. Let's look at a numerical. Now, if I were to take the same question which we discussed previously, and if I were to calculate the accounts receivable days, I would use the formula 365 divided by accounts receivable turnover, and that would give me a total collection period of 69.52, or roughly 70 days. Translation: the company takes 70 days to collect its receivable. This, I would say, is a bad credit policy because the company is taking almost 2.5 months or 2.25 months to collect its money. A higher days receivable ratio means that the company's credit policies are bad and debtors are taking their own sweet time to return my money. A lower accounts receivable ratio means that my debtors are able to repay the money faster and my company has a really good credit management policy. The next ratio we have is the accounts payable turnover. The accounts payable turnover ratio tells me how effectively do I manage my current liabilities, how many times a year am I able to make a repayment to my vendors. Let's look at a numerical. Imagine a company has a COGS or a cost of goods sold of $8,000, the beginning inventory of $150,000 and ending inventory of $250,000. That means that the accounts payable is $200,000. The COGS of this company is $800,000 and the accounts payable average is $200,000. So that means I am able to buy and repay my vendors 4 times a year. I am making a repayment 4 times a year. A higher ratio means that I am able to make my repayment promptly. This could mean my vendor has a good relation with me. A lower ratio means that I am taking my own sweet time to repay my vendor, therefore I might end up straining my relationship with my vendors. This ratio can be further analyzed using accounts payable days ratio. Now what is accounts payable days ratio? This ratio is a further extension of the accounts payable turnover and it tells you how many exact days do you take to repay your vendors. Numerical. If I look at the same numerical and if I convert this into accounts payable days, the formula would be 365 divided by 4 or 91.25 days. So from my perspective, I take roughly 92 days to repay my vendors. From my perspective, I am happy because I'm getting 3 months of time to repay my loans or to repay my vendor. Whereas from the vendor's perspective, I am a receivable or I am a customer who takes a lot of time to make repayment. A lower accounts payable days ratio says that I'm able to effectively utilize my money to pay my vendors on time. Lower number of days equals I am paying my payment promptly. Higher number of days ratio says I am not able to effectively utilize my money, therefore I am taking more time to repay my vendor. This could lead to a strained relationship. We now look at the property, plant and equipment ratio or the PPE ratio. The PPE ratio tells us how effectively does a company use its property, plant and equipment to generate sales. The formula for this is net revenue divided by average PPE. What does net revenue mean? Net revenue means the total sales of the company. And what is average PPE? Average PPE talks about the fixed assets of the company. Let's look at a numerical. Now, the net revenue of a company is 1.2 million. The beginning PPE is 400,000. The ending PPE is 600,000. This means my average PPE is roughly 500,000 and the PPE turnover ratio is 1.2 million divided by 500,000 or 2.4. What does this mean? This means that for every 1 rupee of PPE, I am able to generate $2.4 worth of sales. I am able to generate a higher amount of revenue using the same property, plant, equipment, right? So what does this mean? I am able to effectively utilize my property, plant and equipment to generate sales. A lower PPE means that I am not utilizing my property, plant, equipment to the highest or to the optimal extent and therefore I should probably consider better techniques. The next ratio we look at is the working capital turnover ratio. The working capital turnover ratio is calculated using a formula net sales divided by average working capital. It tells us how effectively do we use our working capital to generate sales. Let's look at a numerical. A net sales of a company is roughly 1 million, current assets 600,000, current liabilities 400,000. So what is the working capital? The working capital is 200,000 and what is the working capital ratio? 5. What does this mean? This means that the company is effectively using its working capital to generate 5 times worth of sales. A higher ratio means effective utilization of working capital and a lower ratio means that the company is not effectively utilizing the working capital to its best extent and should probably consider better management policies. The next ratio we look at is total asset turnover ratio. This ratio tells us how effectively are we able to use our assets to generate sales. Unlike the property, plant, equipment ratio, which only focused on property, plant, equipment, the total asset turnover ratio focuses on total assets. Let's look at the numerical. The net sales of a company is 10 crores, the beginning assets 3 crores and the ending assets 5 crores. So what does that mean? The average assets of the company throughout the year were 4 crores and the total asset turnover is 2.5 times, meaning that for every $1 or for every 1 rupee of fixed assets or what does this mean? This means that for every 1 rupee of total assets, the company is able to generate 2.5 rupees worth of sales or 2.5 times worth of sales. A higher ratio means effective utilization of total assets to generate sales, and a lower ratio means ineffective utilization of total assets, and therefore we are not able to optimally generate sales. Now, a small tip that I would like to share over here. When comparing an income statement item and a balance sheet item, we need to understand that income statement is, or the profit and loss account is as on year ended. It is a total of the transactions for the last 12 months. That is why the title says income statement for the year ended, whereas the balance sheet is a statement of financial position as on date. That's why the title says balance sheet as on XYZ date. Now, why does this become important? This easily helps us understand when we are doing ratio analysis, where do we take the full year figures and where do we take averages. Whenever we are comparing an income statement item with a balance sheet item, the income statement items are taken as a whole, whereas balance sheet items are taken as an average of the opening and closing divided by 2. Example, when I do inventory turnover ratio, I take COGS as a whole, but then I take my average inventory, which is a balance sheet item, as an average. My accounts receivable ratio, again, I take my total revenue as a whole, but my receivables, I take an average. When I do my accounts payable ratio, I take my COGS as a whole, but I take my accounts payable as an average. When I look at PPE turnover ratio, my revenue is a total, whereas my PPE is an average, and so on. Whenever I look at an item belonging to the income statement, I go for average. Whenever I look at an item belonging to the balance sheet, whenever I look at an item belonging to the income statement, I go for the total. Whenever I look at an item belonging to the balance sheet, I go for an average. This is an easy way to remember where do you take averages and where do you don't. The next item we have is the cash conversion cycle. The cash conversion cycle is calculated as days inventory outstanding plus days sales outstanding minus days payables outstanding. What does this tell you? This tells you how much time does it take from the day I purchase inventory from my payables or from my creditors to the time I sell the inventory and I'm able to collect the money from my vendors. A good cash conversion cycle is usually lower. A lower cash conversion cycle represents that I have effectively collected cash and I'm able to manage my cash properly. A higher cash conversion cycle shows that I'm not able to effectively manage my cash, therefore I will have cash crunches. The next item we have is the operating cash cycle. The operating cash cycle is the difference between the days sales outstanding and the days payable outstanding. What does this mean? This tells me how many days of time do I give to my creditors this tells me how many days of time do I give to my customers to make a payment versus how many days do I take from my vendors to make a payment. Example, if my days sales outstanding, that means if I am able to collect money from my customers within 15 days, whereas my days payable outstanding, which means I am able to make payment to my vendor after 25 days, this means that I am able to collect money faster and my repayment is lower, which is good cash management. But if I were to reverse the roles, where I was collecting money from my customer after 25 days and making a payment to my vendor within 15 days, effectively I am financing my customer or I am not utilizing my cash to the best extent. A shorter operating cash cycle means that I am able to collect money effectively, and a longer cash operating cycle or operating cash cycle means that I am taking time to collect my money or to manage my money effectively. The next set of ratios I look at are profitability ratios. They are a window into the profitability of the company. They tell you how good is this company in terms of generating profits. The major or the most popular profitability ratios are gross profit margin, operating profit margin, net profit margin, return on equity, return on assets, return on capital employed, and return on invested capital. Let's look at each of them in detail now. The ratio we're now looking at is the gross profit margin. What is the gross profit margin? The gross profit margin tells you how much is your sales, how much is your COGS, and what is the profit as a percentage of your sales. Let's look at a numerical. Let's assume a company has a sale of 1 million and a COGS of 600,000. The gross profit would be sales minus cost of goods sold, which is 400,000 or 40%. That means that I am able to make a gross profit of 40% for every sale that I make. The next ratio is the net profit margin. The net profit margin is a ratio that tells me how much is the net profit of the company after considering both direct and indirect expenses. Unlike the gross profit margin, which was only looking at cost of goods sold or direct expenses, the net profit margin factors in indirect expenses also. Let's look at a question. Assuming the same question where the net sales was 1 million, the COGS was 600,000. The COGS was 600,000. Now let's assume the operating expenses of the company was 250,000 and interest and taxes are 100,000. Now the net profit margin would be 600,000, which is COGS, plus 250,000, which is operating expenses, and 100,000 of interest expenses. So the net profit of the company would be 50,000 for a sale of roughly 1 million, or the net profit margin would be roughly 5%. The next item I look at is a return on equity. Now what is return on equity? Return on equity tells me how much profit do I make as a shareholder of the company. The return on equity tells me how much profit do I make as a shareholder of the company. Let's look at a question. Let's assume the company has a net income of 200,000 and average equity of the company is roughly 1 million. That means I have made a profit of 200,000 by investing my own money of 1 million, or I have made a profit of 20% on my investment. The return on equity is a percentage calculation that tells the shareholders of the company how much is the profit as a percentage of their investment in the company. Now that we have understood the gross profit margin, let's look at the operating profit margin. The operating profit margin is a ratio or a percentage that tells me how much is the profit of the company after considering all my operating expenses. It tells me it is calculated using the formula operating profit divided by revenue times 100. Let's look at a question. The net sales of the company is 1 million. The COGS of the company is 600,000 and the average operating expenses are 250,000. This means that the operating profit of the company is roughly 150,000 for a revenue of 1 million. Or in other words, I make 15% profit or 15% operating profit for my revenue. So a good operating profit margin says that I'm able to save more in terms of profits. A high operating profit margin says that my cost is low, my sale price is high, I am having good profits. A low operating profit margin says that I am not able to make good profits. Now, the next ratio we look at is return on assets. Return on assets is a ratio which is calculated using the formula net profit divided by assets. This formula tells us how effectively am I able to utilize assets to generate profits. Unlike the previous where we learnt the property, plant, equipment turnover and the total assets turnover, where we were seeing how assets are utilized to generate revenue, here we try to understand how assets are utilized to generate profits. Let's look at a question. Imagine a company which has a profit of 150,000 and the average assets of 1.1 million. Here the return on assets would be 13.64%. That means what? For every $1 of asset, I am able to generate 13 cents of profit. For every $100 of assets, I am able to generate $13 of profit. A high ROA means that the assets are being utilized effectively to generate profits. A low ROA means that the assets are not being efficiently utilized to get optimal profits. Return on capital employed is calculated using the formula EBIT or earnings before interest and tax, EBIT or earnings before interest and tax divided by equity plus debt. This tells me how much are my earnings before paying my interest and taxes as a percentage of my capital employed. Capital employed, what do you mean by capital employed? Capital employed means the total funds invested in the company by owners and by lenders. So that is where I take equity plus debt. Let's look at a question. Let's assume a company has EBIT of 300,000, total assets of 1.5 million and current liabilities of 500,000. This means that the return on capital employed roughly would be 300,000 divided by 1 million or 30%. That means for every $1 of asset, I am able to make 30 cents of profit. ROCE signifies what is the percentage of profits generated for every dollar of assets. ROCE signifies what is the percentage of profit generated for every dollar of total capital employed. A high ROCE or a high return on capital employed shows that my capital is being utilized effectively to generate good profits. A lower return on capital employed says that I am not able to utilize my assets effectively to generate profits. The next ratio we have is return on invested capital. Here, unlike my total capital employed, I just look at the invested capital. This is calculated using the ratio This ratio is calculated using the formula net operating profit after tax or NOPAT divided by equity plus debt minus cash. Why am I deducting cash? Because cash is cash and it has not been invested in any assets of the business. So let's look at an illustration. A company had EBIT of 400,000, a tax rate of 30% and total assets of 2 million with current liabilities of 800,000. Now, the net operating profit or NOPAT would be EBIT into 1 minus tax rate. So, the profit of the company would be $400,000 minus taxes, which is $280,000. And the invested capital in the company is total assets minus current liabilities, which is 1.2 million. The return on capital employed is 280,000 for 1.2 million or 23.33%. What does this mean? This reflects that I am effectively able to utilize my capital and generate profits for the company. If this was low, a lower return on invested capital says that the company is not able to effectively utilize its invested capital to generate returns for the company. Market value ratios, unlike the other ratios, offer an investor's perspective into the stock of the company. The key valuation ratios when it comes to market valuation are price to earnings ratio, price to book ratio and dividend yield ratio. What is the price to earnings ratio? The price to earnings ratio is calculated using the formula market price per share divided by earnings per share. It tells you what is the relationship of the earnings of the company with the market price of the stock. The next ratio is price to book ratio. Price to book ratio is calculated using the formula stock price per share divided by book value per share. This tells you the relationship between the current market value of the share with the book value of the share according to our financials. The final one is the dividend yield ratio. The dividend yield ratio is calculated using the formula dividend per share divided by stock price per share. It tells you what is your return on your investment if you have purchased the stock at today's market price. What would be the percentage returns of your investment? What would be the percentage return of dividend on your investment if you had purchased the stock at today's market price? What is the interpretation of these ratios? The market ratios are helpful in comprehending whether I want to invest in this company or not. A high PE ratio may show that there is a potential for future growth, whereas a low PE ratio might suggest that the company is undervalued. A price to book ratio of more than 1 might suggest that the stock is trading at premium, whereas a price to book ratio of less than 1 might suggest that the stock is undervalued. And a dividend yield ratio is a ratio that attracts investors seeking to earn dividends by telling them what is the percentage of return on their investment at current market price.
Ready to conquer the world of accounting and finance? Like this video, subscribe to our channel and comment the concept you want to learn next.